What is up, everybody? Welcome to the
Hello, hello.
2024 Q1 WellCents Show. Glad you're all with us. My name's Stuart Skolton, my partner Brian Jarasinski with us as well. We're excited to be with you. Thank you for joining us. If it's your first time, give you a little bit of background on WellCents. WellCents is a financial wellness platform and program offered by your employer, by NFP. We are a financial advisory firm, independent in nature, and you've got access to a team of financial professionals like ourselves to really help you with anything and everything financial related. So excited to be with you today. We've got a fun show lined up. I know we're going to get into the market here in a second, but there's a lot of things happening that we're really going to be running through today. We've got Bitcoin back in the news. We've got an election cycle coming up this year. And I guess the big news the Taylor Swift, Travis Kelce economy. Taylor Swift and the Chiefs came into town for Brian last week, and I know Brian was at the game, and that was
Not happy about that.
to watch. So I don't know, Brian, you want to start there? I'll kind of put you on the spot. How are things for you in Baltimore as you recover from that tough loss?
Yeah, that hurt. I tell you, it wasn't as bad as the game prior when it was 10 degrees and I almost lost a couple fingers. But it was a game. I'm living in the DC Baltimore area, and the Ravens didn't play their best game, and the NFL got what it wanted, right? It's funny. I'll go over the market update in a minute. Again, for those of you who are also returning for more than if you're here and you've been here prior, got a little new interface here. So make sure you're always messaging us questions, and we'll make sure we get to your questions as well. But Stuart did a good point to bring up the whole Swift economy. Let's look at the market overview first in 2023. I know a lot of you folks are joining us from our 401k plans that we manage for your respective employers. It was a good year last year. Right, I think everyone was pretty happy overall. If you're checking your 401k accounts, your IRAs, various things, it was hard to find things last year that didn't do well. A third of the S&P was actually still in the red, but last year, as most are familiar, we were led by the tech companies and the Navitas and the Apples and the Metas, and they've actually all continued to roar this year, minus only two of the Magnificent Seven, if you will, are down. But if you look at the whole Kelce Swift phenomenon, the U.S. You read various reports, but basically her tour generated somewhere around $6 billion to the economy in the third quarter. They say it boosted the U.S. GDP. Her GDP alone, fun fact for the day, was larger than the 35 smallest countries put together, or so they're saying.
That's absurd.
It's
absurd. I'd like to know how that's being measured. I mean, how is that being measured? I guess it's just ticket sales, all the influx
airlines, hotels, right? I mean, there's been a lot of spending. If you look at inflation, and we're going to talk about inflation today, inflation last year, 2023, was probably 3 to 4%-ish. But if you take out food and energy and sporting events, sporting concerts, inflation was, or so they say, is maybe mid-high twos. So that's really where the inflation is still continuing to hit all of us. At the grocery stores, at the sporting events, at the concerts. Again, not to push the Taylor Swift narrative, right? But the tickets on the Taylor Swift concerts are all north of $1,000. So they're basically calculating the GDP boost from her and Beyonce and Coldplay and Pink. Some of these big tours last year, generated probably close to $10 billion between all those names I just mentioned. So that's been a huge piece of consumer spending on the market. So, then we got the housing market. That was we had the worst housing market last year. I wrote it down here since 28 years. It was the worst housing market in 28 years as far as number of home sales. You can attribute that to the high mortgage rates. You can attribute that to low inventory. But we're going to see what happens because it's a big election year. So, Stuart, what are you telling folks with the uncertainty of the election year? What are you seeing?
Yeah, it's funny. I mean, the conversation we always have with clients is to stay the course. I mean, really, it doesn't matter. There's a lot of interesting data out there. I think people tend to want to invest more aggressively when their team is in the White House. So I won't get into the politics of it, but the reality is that people that tend to do the best, and the stock market, believe it or not, does the best when there's actually divided government. When you've got a red or blue White House, the Senate's actually controlled opposite. An opposite party holds power as well. So for whatever reason, the market seems to like split government and kind of that deadlock in Washington. I think it's safe to say that there will continue to be some type of deadlock in Washington coming out of the election, but it remains to be seen. And really all we can do as investors is stay the course, keep that long-term focus. and just make sure that you're ultimately staying disciplined and reaching your investment goals. That being said, it's a good time to reevaluate. As we get into the first quarter of the year, New Year's resolutions, everyone's thinking about how they can maybe save a little more money, budget a little bit more effectively. Some things to just keep in mind as you go into the year. Maybe thinking about those new contribution limits that you have access to in retirement plans and IRAs specifically. So those have gone up a little bit. Just reviewing your portfolio, making sure that you're on track for your retirement goals, and then ultimately budgeting really well. I mean, we've done a lot of conversation around those topics in the past, so I won't get too into the nitty gritty, but that's certainly something that you can ask us, and hopefully you're setting some time up with your spouse or your partner to really go over those finances, just where you're saving money, money's coming in. Your employer really provides you with a financial plan, right? They give you a paycheck, they give you income, and then they give you some insurance, right? You probably have some access to health insurance. So you have all of the tools and resources necessary. And then, we're really here as the team to help you put that all together. So if you have unease about what's going on in the markets, you've got questions about it, you've got questions about the election year cycle, those are great questions to maybe talk through with someone to help ease the nerves a little bit.
Yeah, I mean, ultimately, if you look back we're somewhat in the business of probability and predictability, right? Every year, Morgan Stanley, Merrill Lynch, Goldman Sachs, Wells Fargo, every bank and every brokerage firm comes out with their S&P target for the end of the year. Pretty much every single year, they all miss, right? They either fall under or over. Lot of folks, a lot of predictors last year were well under what they thought was going to happen. We ended up 24% on the S&P last year. But this year so far, if you look at election cycles, the S&P's been around, I believe, 23 election cycles. 85 of those have been positive. There's only been one double-digit election year where the market was negative by double digits. And I think that was 2008 Obama. We were down pretty heavily in 2008, obviously with the housing bubble. So we look at probability, interest rates going down. We'll talk a little bit more about interest rates today, but again, the Fed came out into last year. They said, look, we're gonna shelf the interest rate hikes that we've been doing for the last year and a half, 2 years. We're now at 23-year highs on our Fed funds rate interest rate. So historically speaking, when rates start to go down, there's more liquidity starts opening up in the system. More individuals, more companies can get easier access to loans and cash. Then we tend to see a boom. So election year, lowering interest rates, hopefully. Again, they're projecting they're going to start lowering interest rates. They don't meet again until end of March. So we'll find out what the Fed's going to do once they get there. But, again, as long as we can, make sure that the global unrest and the stuff in the Middle East and the Russia supply chain stuff with the energy, if we can try to bottle up some of that stuff, hopefully we get some new elections in there, right? Obviously, at this point, I don't know if Stuart, if you agree with me, but it looks like no matter how many lawsuits Trump gets against him, it looks like he's going to be the front runner on the Republican ticket. And then once Haley steps out, which she probably will soon since DeSantis stepped out. But then from there, it's obviously against Biden, or some are hypothesizing he's going to drop out suddenly and Michelle Obama is going to take that ticket. So we'll
remains to be seen. I mean, I think the challenge is for a lot of people is just realizing that, the market likes things that it can see and predict. And so to some extent, I don't know which way the market's pricing in. Different algorithms, and there's so much happening behind the scenes in terms of what's dictating how the market does and where the expected result is of the election that we couldn't even know. But I think once the things like the election are decided, then that gives the market more certainty, and then things kind of recalibrate moving forward a little bit in certain sectors of the market that might lean one way or the other. So it's just interesting to see how the market deals with uncertainty. And that's really what causes that volatility. So we get through things like the election and things ultimately normalize over time. That's the guidance that I give to clients.
Yeah. Ultimately the market overview is last year was a good year. So far this year, it's a good year. We're at all-time highs so far on everything except the NASDAQ and the Russell 2000, which is your smaller cap stocks. But the S&P, the Dow Jones, we're almost back to all-time highs. But it's been a good year. If you look at the 15-year return on the S&P now, we're at about 12%. So historically speaking, long-term growth in equity in the equity markets, normally 8 to 12%. So we're in a good run here. So again, and I also want to make sure we tell you guys, make sure you send questions, because Stuart and I are going to kind of jump into the part where we're shooting you good information to make sure you kind of write down, because as we enter the year, just like we did in the fourth quarter, things to think about as you're ending the year, there's some very important things you want to think on your financial planning for beginning of the year. And the first thing I would go at is tax, right? Like you really want to make sure that you're assessing your tax situation. We always have a couple tax changes every year, a couple new things. For example, the standard deduction just went up. The 401k limit that you can defer just went up. The IRA amount that you can defer just went up. We got some other changes. Obviously, the tax bracket creep, so that tends to go up. So the biggest detriment, Stuart and I always tell our clients, and honestly, I tell myself and friends and everything, is the second biggest detriment to growing your wealth and your financial planning is taxes. Because at the end of the day, we pay taxes on the money we make. We pay taxes on the money we already got taxed on spending things, on sales tax, and then we have to pay tax on things we already own, right? You're talking, your property taxes and your car taxes and all those various things depending on the state that you're in. Limiting your taxes and being very efficient on not paying Uncle Sam as much as you need to is extremely important. So again, we're not CPAs, but we partner with a lot of CPAs and/or work with our clients' CPAs directly on managing various things. So make sure, if you haven't scheduled that, sit down with your CPA. And before I turn it over to Stuart, I will mention one thing. I was telling Stuart, I just got back from the dentist. I ended up switching dentists after 25 years. Long story, I won't get into it. But they had trouble getting a dental hygienist. And the doctor was doing the cleanings, and they just so understaffed, they forgot to call me for my 6th month. And I was overdue and went to another one, and they did x-rays and found out there were minor issues that they could fix without a surgery. But sometimes you just don't know what you don't know. So my point is, if you have a CPA and I got a CPA, I'm good, get a second opinion. It doesn't hurt. You have a financial planner, get a second opinion. Because you never know, based on how they run their business or things that are going on, that they may miss something. Obviously, typically not on purpose, like what happened to me in the dentist situation. I'm all good now, but that's important stuff. So make sure you're getting on scheduling your CPA and reviewing your taxes, especially given the new tax updates that came out for this year.
I like the question from Jenny, because I think it's relevant for a lot of people that are maybe trying to do some investing on the side. And by on the side, I mean, I think we're all investing in our 401ks, our 403bs, our retirement plans, hopefully. But, when you're looking at outside accounts, what are the best platforms that are out there? There's so many of them. And, I think choice is a good thing. I mean, the financial services industry has done a really good job in the last decade of improving access on the brokerage side, the ability for investors like ourselves to go in and be able to buy a lot of these companies that we hear about in the news and have a chip in the game, skin in the game, whatever you want to call it. Some of the best sites, I think it's a bit of a relative term. Obviously, you want to be with probably a national carrier, a platform that's reputable. Some of the ones that we like are Fidelity, Charles Schwab, Vanguard. And then you get into kind of the Robin Hoods of the world that are maybe a little bit more gamified, and they give you some different bells and whistles that you might have access to. So, best really can be relative. You want to look at what fees you're paying. Naturally, I think is something. Some different sites will charge you transaction fees, or there might be some buy-sell restrictions that you'll want to look at. I tend to recommend and encourage people to stick to one of the big, more national carriers. So again, those Fidelity, Schwab's, Vanguards, they're going to give you access to enough research and data to make an educated decision, but they're also there's some strength in numbers there, right? As they're a bit more reputable than some of the smaller organizations, I think, that might have more of the gamified component. I don't know. You want to add anything, Brian?
Yeah, I mean, and like anything, the banks consolidate. They always buy each other. The insurance companies are always buying out each other. Schwab has been the local one that's been gobbling up a lot of these brokerage companies. I used to have Ameritrade, now it's Schwab. Again, I can speak from personal experience. I'm happy with Schwab. That's where I kind of do my more speculative type brokerage investing. And, obviously with a brokerage, right, you can go get anything, which is a nice thing to have. Since, 401ks are kind of what I would say plain vanilla, right? You have 30, 40 mutual funds to choose from, and that's kind of your steady Eddie. And then you can do IRAs and brokerage accounts where you get access to, much more options and, much more speculation type things. But yeah, I'm always been a Schwab fan. Well, at least, I mean, since they merged, within a year ago, it's boded me well. And again, utilize us. I mean, we're happy to, give you, email us. We'll happily send you some links and places to check out. But, they're so consolidated now. There's really only a few good reputable ones to choose from, and that's where we tend to send folks.
I think that the other benefit of the brokerage side of things or an investment company side is just they offer you a lot of times better cash management. So I think everybody has heard about high yield savings accounts. It's something we talked a lot about last year, is just giving you a lot better interest rate for cash management purposes. But when you open up a brokerage type vehicle with a Schwab or a Fidelity, they're going to give you access to other types of money market instruments, so cash equivalents. And the rates on those are still in that 4.5% to 5% range. Sometimes they're even a little bit better than high yield right now. So I think having that secondary account that you can pull money in and out of, it's more liquid, it's not a retirement specific account, can be a great way to just manage some of that cash. Not necessarily putting it all into a more speculative investment, but just providing you some cash management options that you might not have with your local bank or credit union.
Yeah, and that's something Stuart and I have been harping on these educational podcasts and all our personal client meetings and our one-on-ones and with our 401k participants for 4 quarters, really 6 quarters now.
Yeah.
Assess your cash management, because the market is just, again, we're at all-time highs on the S&P again. The market's done well, and we're still at that pinnacle point, or at least we think we are, of interest rates at almost 5.5 from the Fed funds rate. So, you Google right now, go to like a nerdwallet.com, look for the high yield savings. I can tell you my current bank high yield savings accounts are still 4.5 to 5.25. They're probably going to start dipping here. At least that's where the probability says they're going to go, with some rate reductions coming. But we're living in a world where you really want to watch your cash management. There have been some big firms. I don't want to name any names, but there have been some big firms who've had some big lawsuits that their cash management throughout the last year and a half was paying pennies when it should have been paying a lot more. So there've been a lot of those in the news. So again, while the rates are still here, assess that. Am I getting 4.5 plus on my liquid cash, FDIC insured? If I'm not, we want to check into that. To Stuart's point, on my brokerage cash, am I getting that 4.5 plus %? You should be. Right? If not, that's just sitting in cash, making 0.1 or whatever. That's something we want to assess.
Yeah, before we move on here, I think it's worth just touching on the tax situation a little bit. I was playing this little game, and I do it with my wife sometimes. I don't think people realize how much they pay in taxes. I mean, if you think about it, for you to go spend $100, let's say, or maybe let's use a bigger number, for you to go buy a flat screen TV for $1,000, you have to earn probably close to $1,250 or $1,300 in most cases to go spend that $1,000. Then you're paying another sales tax in a lot of states. I mean, California, we're looking at about another 8%. So, that's eating into the cost as well. They're taxing you when you buy it. So if you really want to play a little game with yourself and see where your money's going, people say, hey, I don't feel like I'm getting ahead. I don't feel like I'm able to save money. It's because the consumption situation that you have, you're probably have to make $150 to spend $100. And so I think that's something that's just worth, kind of taking a closer dive at when you're looking at the amount that you're being taxed on the front, amount you're being taxed when you spend it. It's very expensive to be a consumer right now. That's the reality of it. And so budgeting really effectively can be something that really changes your outlook. It really can change your long-term perspective just on how you're spending money.
That's great. I mean, let me get to, it looks like Jenny had a good question. Should small business owners get a financial advisor? CPA does the taxes. I feel like he doesn't provide any additional info on ways we could save utilized deductions. So quick biased answer is yes, right? I have a lot of small business clients. Look, there are different categories and animals of financial advisors, CPAs, mechanics, doctors, whatever, right? In any profession. So some CPAs, do provide some of that stuff. Some don't. If your CPA is just saying, hey, give me your tax returns and punching the numbers and filing your taxes, you pay your fee and that's it. Yes. Do you have the right retirement plan? Are you paying too much on your benefits? Do you have the right benefits to acquire and retain good talent? Depending on what sectors the business in, what's the end game succession? Is it to family? Is it to sell it? And all those things come to structuring in the business in the right way, so you pay as little in taxes, not just along the way, but on the back end. A lot of business owners are so, and rightfully so, they're busy trying to drive business, right? They're busy trying to drive revenue and keep the business afloat and successful. The worry is not things that are 5-10 years away or trying to minimize taxes and costs as much. So yes, That'd be my definitely reach out to a Stuart or myself, or interview a couple of CFPs. You certainly want to bring one on if you're a business owner.
Hey, before we get to some more questions, let's talk about Bitcoin a little bit. That was something that's just been in the news a lot the last month. It's back in the news for different reasons. I think it was a bit of a manifest destiny that Bitcoin was eventually going to be approved by the regulators in a different investment type vehicle. So now Bitcoin ETFs are fully vetted at least enough to offer on the Wall Street exchanges. So it's just a bit interesting to see that back in the news. Brian, I know you and I had talked about this a couple weeks ago when it was really, really fresh. And it was interesting to look at some of the tracking error that was happening between the Bitcoin ETFs and then the actual underlying Bitcoins or the cryptocurrency that these ETFs were tracking. And there's quite a big discrepancy there. I think a lot of people don't realize that there's discrepancy when you jump into a product that's tracking, I'll call it a commodity, but an underlying investment like a Bitcoin. That can really change quite a bit in terms of how you're thinking about investing. There's different volatility there. So I don't know, Brian. Maybe run through some of the up-to-date numbers here.
Yeah, look, Bitcoin's the sexy hot topic for the last 5 years, right? It's a very speculative asset. There's no underlying asset protecting it. It's just, are you willing? Is there someone out there willing to pay more for it than you bought it for? Right? That's kind of it's kind of like trading baseball cards, kind of investment, but very speculative. But yes, these ETFs went live, I believe, a month and a half.
Yeah.
And obviously, Wall Street's capitalistic, and they said, hey, everyone out there wants Bitcoin, and Coinbase is sucking up the money, and we need to make something that we can get investment dollars into it. So 13 of them came out. The vast majority of the billions that have gone into these things in short order have gone to iShares, which is BlackRock or Fidelity. Year to date, they're both down around 7-8%. They're not identical. They're close to one another, actually, those two at least, which is interesting. But Bitcoin, I think, year to date is basically flat. So if you just bought Bitcoin through Coinbase or bought one of these trackers, so far there's an 8% differential. So I've had so many clients, probably like Stuart in the last month, calling me, Brian, I love Bitcoin. I want Bitcoin. I see that it's securitized, and now I can trade it a lot more easily. It's somewhat more regulated. I can get cash easily quicker from it versus having to sell the actual Bitcoin on Coinbase.
Brian, didn't you almost have to I won't put anybody on the spot here, but like, didn't you almost have to tell a client, hey, you need to go in a different direction. I'm not your guy. You're not throwing all your money in Bitcoin. I mean, that happens.
It happened. Yeah, I had one guy call me. He's like, I want to put it all in these Bitcoins ETFs. And given his financial picture as a CFP, it's not a suitable thing to do. I'm like, look, I can't say that's a suitable thing for you to do, to put all your assets into speculative Bitcoin in a new ETF. It doesn't even track Bitcoin well so far. And there's a lot of speculation on how these companies are buying the coins, et cetera. So yeah, it's kind of one of those wait and sees, right? I think when the SEC approved the ETFs, they said, we approve it, but we don't condone it, right? It was kind of one of those things where, there's probably some politics involved as to why the ETFs were approved. But I don't think it's a bad investment. I think it has its place, but it's something that we want to continue to keep an eye on and see how it's tracking, and also see how all 13 are tracking against each other, because they're not all returning the same either. So it's just one of those kind of things you got to be careful of.
Let's get into another question here. So Courtney asked on advice for saving for children's future, maybe, other vehicles and 529s, pros and cons. I think 529 plans are still the vehicle of choice. I mean, obviously that's the account that we open up for a lot of different clients. I think they offer you a lot of benefits in terms of saving for college education, college expenses. The fact that you can change the beneficiaries so easily on 529 accounts is something that's really worth just taking a second look at. I know there are some drawbacks, and maybe it's not a retirement specific account. It's a college savings account, but there's some really creative things you can do as far as conversions with 529 accounts in certain states. So, that's something that I would encourage Courtney, just maybe take a look at that if that's an option where you're at. Brian, I don't know, you want to add any color?
Yeah, look, Courtney, this is bread and butter what we do, right? We get these, we do education planning for clients all the time. So the first question is sitting down with the parent or the parents and saying, look, how much do we want to fund for college? A lot of parents love their kids, grandparents really love their grandkids. And a lot of these, parents and grandparents will forego their own retirement to save for kids' colleges. So we'll always try to say, look, as much as you love your kids, we got to make sure you're taken care of first. then let's talk about, what your projection. We don't know if your 2-year-old, like I have a 1-year-old. I don't know if she's going to go to college. I hope she does, but the world could be different in 18 years. Who knows? But I have 529s for her. I have UTMA accounts for her, which are uniform transferred gift to minor accounts. So basically, whenever I give a contribution to that, now she technically owns the account, but it's her money, but she just doesn't get access until she's 18. So it doesn't have to be used for education. As Stuart mentioned, the 529s, the Secure Act 2.0, allows you to convert up to 35,000 at the yearly limits. Based if you've met a few criteria, like you've had the 529 for 15 years and the beneficiary is the same person, you can convert that money now to Roth IRA dollars. So you could just say, hey, my son or daughter is going to go to college, and all of a sudden they get a full scholarship or they don't go. I can start to convert that money to a Roth IRA for them and have them, 10% year over year, 35 grand. That's almost $1 million at 65 by itself. I know in a long time from now, what's $1 million really going to be worth? But it's still a good start. So point being, 529s are giving you more options than they had before. So that's an avenue to look at. UTMA accounts, brokerage accounts, but yeah, it's really just depending on what the plan is, and then someone like Stuart or I can help you structure that.
Yeah, no, great points. Let's get to another question here. So as far as retirement planning goes, Jim had asked, how many years before planning retirement should someone consider moving money investments to safer investments? This is an interesting conversation, and frankly, it's one that I'm having with a lot of clients right now that are maybe at retirement or they're close to retirement. And after working with them for a number of years, it's very common for an investor who's been somewhat, we'll call it aggressive, most of their career suddenly has a bit of a paradigm shift where, hey, now I'm retired. I have to suddenly move into this protection mode with my assets. And I think the mistake that a lot of people make is that they go too conservative all of a sudden. They just flip this switch. Hey, I'm not working anymore. I've got to kind of shove my money under the mattress. And the reality is that the risk for most people in retirement is not going to be market volatility. It's going to be inflationary risk. The risk that you're not getting enough of a rate of return on your principal and your portfolio to be able to have that those assets last you all the way through retirement. So there's that inflation risk, and then there's that longevity risk that you run out of money in your 80s and 90s if you live longer than expected. So the cautionary tale is don't move to something that's too safe. You still want to have some skin in the game. You still want to make sure you're getting some investment market growth. So to more directly answer Jim's question, this is more of a drawdown as opposed to a switch flipping. In the target date world, I know a lot of us have access to target date investments in our retirement plans. We call it a glide path. So slowly, as you get older, as you get closer to retirement, you're moving away from being 100% aggressive, maybe having 100% of your investments in stocks or equity, more of those growth-oriented vehicles, to starting to add some bonds, starting to add some money markets, fixed income, but you really never want to get too conservative. You should still always have probably 50 to 60% of your account in something that is going to keep up with the market and offer you some growth. So that's the color I would add there.
Yeah, and again, just to piggyback on that, I get this question all the time, just like Stuart does, and my quick response is it's the cart before the horse question. Because my response as a CFP to that question is I have absolutely no idea, right? It solely depends on your plan and how much money do you need from that bucket that you're talking about, and when do you need it, right? So when some people retire, they still don't need to draw from that investment pool yet. They have pensions they're turning on, a spouse is still working. So you have to put the plan together first before you can figure out how much needs to be in safety. Right. Like I have, like, for example, I saw a client come in the other day. He was 65. We got a younger spouse. She's going to still be working for 5 years. Her income is more income than they need. And he was already making, she's going to work for another 5-7 years, at least projected. He had probably half his money in stuff that is what I call non-variable, right? Just kind of fixed money market accounts. Again, not a bad idea in the market where you can get 5-6% without any risk. But it just depends. So the more important thing, Jim, to ask or get with your planner on is how much money do I need from this bucket and when? Then me or a Stuart or any financial planner can back into the answer to that question. But ultimately speaking, if you start at high level, if you need income from that pool of money, you want to start putting money to non-variable investments at least probably 5 years prior to that happening.
Yeah, and maybe just to take the conversation to another level, really the reason you move into safer investments is you're really trying to guarantee a portion of your account from loss. And
Right.
so that's really where you'd be maybe looking at some insurance type vehicles, some guaranteed income for life type vehicles. We've talked about those in the past. It's obviously a great time to be looking at those while interest rates are higher. I mean, that's something that we've spent a lot of time with on clients that have had those insurance type products. Maybe they bought these products in a lower interest rate environment, and it's time to kind of re-benchmark, almost like refinance. You might refinance your house when the market's down. With a lot of these policies that were purchased at lower rates, a great time to refinance them or kind of shop them around again is when rates are up. So looking at those guaranteed products for that safety component, and then still allowing some of your investable assets to be a bit more aggressive and long term is a great way to look at the conversation. So we're happy to have that conversation with you, and that's it's definitely worth taking a look at.
Yeah, and look, you follow the money, right? In the last year and a half, Stuart and I could probably tell you. I mean, we do, we're NFP makes 0 products, right? We have access to the banks, the insurance companies, the financial firms, and in the last year and a half, probably 70% of the new assets for retiree type folks has been into fixed income products because it's the highest rates in 23 years, and probably starting to lower here soon. So a lot of people are capitalizing on that. Hey, if I can take my 401k that's been doing 6-7% like this for the last 10 years, and I can go get 6% with just no risk at all, that's an option. Let's discuss it. So that's been a pretty commonplace for our pre-retirees and retirees in the last couple of years. I've been doing this 20 years. You rewind 3 years ago, it was tough for a retiree because if they wanted safety, okay, we might be able to get you 2-3% in safety. That's just, it is what it is. That's what it was. So you're seeing more and more of those conversations. And then again, the rates don't, probability wise, they're not projected to start going down crazy. The Fed said they're projecting 0.75% rate drops this year. We'll probably know more when they come out into March and have their meeting, but it's all TBD. But yes, that's we're seeing a lot of that stuff in commonplace because you got to remember when banks take your money and when insurance companies take your money, you're what you have is just a number on a computer screen, right? A bank takes 10 grand deposit from you, they're loaning $9,000 out, right? And then that person's depositing that $9,000 into another bank, and then they're loaning that $9,000 out. So that's kind of how money is made. But when interest rates are high like this, there's a lot of juice in the squeeze for the insurance companies and the banks. So the products thus get more advantageous as well.
Yeah. Let's talk a little bit about estate planning. So this is something, was interesting. I was reading an article on financial crimes and just a lot of fraud is going on right now. I think we're hearing about just from certain clients, a lot of phishing emails, a lot of emails from unsavory bad actors, trying to get access to their financial information. I've had to update a lot of banking info for clients in the last couple of years, at least several, where accounts have been compromised and things like that. So just, for anybody that's in the 50 and up category, just be aware that you're really in a targeted category for bad actors, right? They know you have more money than the 20s and 30-year-olds in most cases. And they're really trying to run a lot of scams, and those financial crimes and fraud and phishing are all on the rise in that 50 plus crowd. It's something like 20% of all the financial crimes that are happening right now are happening for seniors, like in that 50 to 60 range. And then the numbers go up exponentially as you get even older. So there's some things you can do to protect yourself and your accounts. Two-factor authentication is the one that I think everybody's starting to see a lot more of, where, to log into your 401k or to log into your bank account, you might have to get a text code and then verify that code before it lets you log into your account. That's definitely something worth opting into. And then on the other side of it, just making sure that you have a trusted contact listed on your account. That's another layer of security that you can have. If for some reason something happened to you, your advisor or your record keeper wasn't able to get in touch with you, they could go to another trusted contact that you could specify. A lot of times this is different than your beneficiary, but it's somebody that has your best interest at heart, and obviously somebody could work with them on your behalf if for some reason the security of the account was compromised. So ties into a bigger estate planning conversation. I don't know, Brian, you can probably add some color there, but it's something that we're talking to a lot of clients about it, and it's definitely on the rise. A lot of bad actors.
Yeah, I mean, we got friends, and the other big thing last year and going into this year, and really the future is we're entering AI, right? Like AI is the big push. I know NFP's looking into different AI stuff, and if any company isn't, they're really falling behind. But that's why Nvidia's up 37% this year again after going up. What were they up? I don't even remember what they were up last year, 230% or something. But AI is the next wave, and sadly, with elder abuse and scams, AI has been more efficient at ripping people off. Like I had a client call me earlier this year from her bank that came up as a bank number on her phone, right? Like it said it was like not Bank of America, it was something, her bank name. And they said, we have to text you a code. And she got a code to verify. It was very well done. And they ended up getting her for, I don't remember the details, but it was very well done. And they ended up getting her for a few thousand. And thankfully the bank reimbursed her and they changed their accounts and everything. But you just got to keep your head above water for those things, because there's a lot of those out there, and we're all getting so much spam on our phones and emails these days, and AI is only going to make that. Sadly, there's good stuff with AI that's going to come with it, and there's going to be unfortunate stuff like that. So, and then I saw a couple of the questions here I want to make sure we hit. So Kaylin had where do you do UTMA accounts? Kaylin, almost anyone can do them, right? Go to any financial planner, any bank advisor. We set up UTMA accounts all the time. Like I said, I have one for my child. But there's some institutions that don't do them, but probably the majority do. I mean, we have a few special ones that we typically use, but again, reach out to us. We can give you a couple. We can do them for you. But they're pretty well versed to grab from various institutions.
Shelly asked about insurance, guaranteed safety of income. Yeah, so a lot of these are known as annuities. We're definitely not annuity salespeople. We don't push a particular product or service. As Brian mentioned, NFP is not a carrier in that regard. They're not NFP products, but the technical term, an insurance product that offers you guaranteed lifetime income is commonly known as an annuity. And we certainly don't advise. There are drawbacks to them from a liquidity standpoint. You don't want to put all your money in a guaranteed product necessarily. But for really that part of your account that you're looking for safety of principal, that's really where there's annuities can have a lot of value, especially when rates are high. It wasn't the case a few years ago as much. Now it's a different conversation.
If you look at where the money flowed in 2022 between bank CDs, money markets, high yield savings, and fixed annuities, maybe even fixed indexed annuities, I mean, multiple billions. The records were broken across the board of the flow into those than any year in human history. One, because there's more money in the system, and then you mix that with the rates where they are. Again, that's just where the money flowed last year, and it's really still doing that. But as rates tend to, if they do start to come down, obviously we'll probably start to see a shift in that.
Brian, are you? Thomas asked earlier, are you concerned about the inverted yield curve at all?
So just for those in the call, inverted yield curve kind of means you're getting more on the short end of the curve versus getting like a 30-year bond and getting more for it, right? Because you're giving your money you're giving your money as an IOU to someone for longer. So you can actually get more value by buying the shorter term. And historically speaking, again, probability, it doesn't guarantee this. Normally when the yield curve gets inverted, it tends to signal a recession. And thus usually you see the Fed step in and do exactly what they've been doing and raising interest rates. So I'm not too concerned about it. It's like anything else. It's a predictor, but it's not necessarily an end-all be-all that it's going to predict what's going to happen.
Yeah, I think that's a fair point. Setting up and evaluate different Roth options. We'll get to a couple more questions here before we wrap up. Roth options really just the shell. It's just the vehicle that you invest in. So going back to the question that was asked earlier about different custodians that you could look at, I think, again, it's just really picking a platform that's reputable. As far as evaluating the options, really the options that you have to ultimately evaluate are going to be the investment options that you choose to invest in within the Roth IRA platform, the account, where you choose to set that up. So just like any long-term retirement account, it's picking a diversified mix. We advise a lot of different index funds, mutual funds, things like that give you that long-term growth, but just choosing a platform that works for you. So again, the Schwabs, the Fidelities of the world, the Vanguards, those tend to be great carriers to look at.
Yeah,
you want to get another question or two, Brian?
Short-term T-bills or savings accounts, tax advantages. I mean, again, depending on when you define short-term, right? T-bills are basically, a year and in. right, for T-bills. I think when I looked yesterday, I think the best T-bill on a 52-week T-bill, I think was 4.5, somewhere in there, 4.7 maybe. They're starting to come down in the last month. They're when you buy a T-bill, you can sell it on the open market pretty easily, especially if rates are starting to go down. That you might get a little bit of juice when you sell it on the back end, but it just depends what you're buying it for. Obviously, savings accounts, if you do a high yield savings, you're fully liquid. Plus, you have the FDIC insurance. You could argue the T-bill is just as safe, obviously, being a government T-bill, but it just depends on what you're buying it for, right? I mean, either way, if it's a short-term investment, you're going to have ordinary income tax that you're going to pay on the thing. You get a 1099 from, the government or from your Capital One or Bank of America.
Yeah, that's a good question. I think people, as we kind of wrap up the show for this month, it's a really good time to be looking at this. I know we say this every time, like it's a good time to be looking at your finances. Like it's the start of the year. It's time to really continue to hone and develop that plan. Ultimately, this year is going to be about the same thing it's been the last several years. It's staying the course. There's all sorts of variables we can't control economically, politically. And there's events that are going to happen this year that we don't even know about yet. And it's going to affect the stock market. It's going to affect our accounts. So keeping that really long-term disciplined approach is ultimately what allows people to retire comfortably and stay on track for their goals. And at the end of the day, Brian and I just want to be resources for everybody. I know we've met with a lot of you. We've had meetings. We've talked about some of the different products and vehicles that are out there. Our job is to be the experts and try to show you a suite of what's best in class right now. So if you do want to have one of those more financial planning type sit down reviews, feel free to reach out to us, especially if you're close to retirement. I think if you're in that 60 to 65 category where retirement is right on the horizon, you can see it. You're probably doing a lot of things right, but maybe you haven't just sat down and really evaluated the plan. Maybe there's just some fine tuning that needs to take place. It's a great time to do it. The market's up again and interest rates are up. So you've got a lot of options at your disposal. I think that should be encouraging for everybody on the call. Brian, do you have any other final words?
Look, again, to Stuart's point, these are for your education. We're here as a resource for you guys. Utilize it. Come to these quarterly meetings. I mean, every quarterly meeting, we try to just kind of hone it in on that time of year and what's important to do at that time of year. But again, beginning of the year, Super Bowl week, right? We got, hopefully we got a nice boost in the next couple of weeks of the election noise, and we'll see how that progresses through the year. But look, just like Stuart said, and I've been saying, get with your accountant. That's first and foremost. Continue to check your cash management. Make sure that's good. If you're close to retiree or have some of these educational funding questions, let us know. We're happy. Again, a lot of times we do these, and Stuart and I will probably have 10, 15 calls of people that reach out and get on our calendar. And they're nothing else but informative. And, thanks. We appreciate the call, to Ellen, Stuart, and I, and they're good. So we're happy to be that resource for you guys. So just keep us posted. Make sure you keep our contact information handy and, grab us when you need us.
Thanks, everybody.
Yeah. Thanks, everybody. Appreciate it. Enjoy the Super Bowl. Go 49ers, by the way.